The resale price method is one of the 5 main transfer pricing methods used to determine whether transactions between related companies comply with the arm's length principle. This method focuses on determining the appropriate gross margin for a distributor or reseller by referencing margins achieved in comparable transactions with unrelated third parties. At its core, the resale price method uses the selling price of a product or service, also known as the resale price, and adjusts it based on the gross margin earned by independent resellers in comparable transactions. The gross margin, in this case, is calculated as gross profit divided by net sales. The aim is to ensure that the resale price charged by the controlled entity, such as a distributor within the same corporate group, falls within an acceptable range of gross margins observed in the open market. For example, if a US-based distributor buys tennis rackets from a related entity in China and also buys similar shoes from an unrelated third-party supplier, the gross margin from the third-party transaction would be used as a reference to ensure that the gross margin from the related party transaction remains within a comparable range. This prevents distortions in profit allocation between different tax jurisdictions, as might occur if the Chinese supplier sells the tennis racket at an artificially high price to minimize taxable profits in the US. The resale price method is typically used in transactions involving tangible goods, especially when a distributor or reseller is involved. It works well when there are reliable comparable gross margins from similar products and market conditions. However, this method may not be appropriate for transactions involving intellectual property. A key advantage of the resale price method is that it allows for minor differences in the characteristics of products being compared. For instance, a distributor may sell the same product in different colors or slightly varied designs, yet the overall gross margin would remain comparable. This flexibility in product characteristics makes the resale price method suitable in cases where the exact same product is not available for comparison. In that case, the comparable uncontrolled price method would be more appropriate. While the resale price method is effective when applicable, its use is constrained by the availability of reliable data. One major challenge in applying the resale price method is ensuring that the gross margins from third-party transactions are truly comparable. For instance, accounting differences across countries, particularly in the way they classify cost of goods sold and operating expenses, can skew gross margins and affect the analysis. Additionally, the resale price method may be less effective when there are no comparable third-party transactions to serve as benchmarks. Another challenge is the complexity that arises in multinational transactions. Tax authorities from different jurisdictions may interpret the application of resale price method differently, particularly concerning which gross margins or product variations are deemed comparable. Ease of use. When appropriate comparable transactions are available, the resale price method offers a straightforward and effective method for determining arm's-length pricing in intercompany sales. Flexibility in comparability. The method allows for minor differences in products, making it more versatile than the comparable uncontrolled price method, which requires nearly identical products. Clear allocation of profits. Resale price method focuses on gross margins, ensuring that distributors within a group earn a comparable return to independent parties, making the profit allocation more transparent. Data limitations. A significant drawback is the reliance on comparable transactions. In industries or regions where such data is unavailable or difficult to obtain, resale price method may not be applicable. Variations in accounting. Differences in how companies report costs of goods sold and operating expenses can distort gross margins, potentially leading to misinterpretations of comparability. Limited to tangible goods. The method is generally limited to transactions involving physical goods and may not be suitable for intellectual property transactions. Consider a scenario where a distributor buys electronic devices from a related party in one country and unrelated third parties in another. Under the resale price method, the gross margin earned by the distributor in the uncontrolled transaction with the third-party supplier serves as the benchmark. If the distributor earns a gross margin of 20% in the transaction with the unrelated supplier, the same margin should apply to the controlled transaction, ensuring that the pricing is consistent with the arm's length principle. The resale price method plays an important role in transfer pricing, particularly for transactions involving tangible goods between related parties. Its strength lies in its ability to ensure that distributors earn a reasonable profit margin comparable to what they would achieve in an open market. However, the method's effectiveness is highly dependent on the availability of reliable comparable data and the consistency in accounting treatments across companies. While the resale price method offers some flexibility regarding product characteristics, it requires careful consideration of gross margin data to ensure arm's-length pricing. As with any transfer pricing method, understanding its limitations and proper application is critical for compliance with global tax regulations. For businesses operating across multiple jurisdictions, the resale price method offers a practical solution for pricing tangible goods transactions, but requires a detailed and thoughtful approach to ensure that all benchmarks and comparable data align with the arm's length standard.